Today we're diving into what I'm calling the Swiss franc mystery, decoding a pretty massive divergence in the Forex market. If you've been anywhere near the charts for the week of July 27th, you know things got a little wild. We're going to unpack exactly what drove these completely captivating market movements. So here is the big question. Why did the world's ultimate safe haven currency just absolutely crash this week? Seriously, when we think of financial safety, we instantly think of the Swiss franc, right? But while other major currencies held the line this week, the franc just completely cratered. And today, we're going to investigate exactly why that happened.
Let's kick things off with Section 1, the scene of the incident, tracking this week's winners and losers. Looking at currency strength across the board, the tiers are practically jumping out at us. Right up at the top, the New Zealand dollar led the pack, with just extreme resilience. I mean, even as other currencies pulled back, the NZD barely flinched. Right behind it, we've got the British pound holding really strong. But then, look all the way down at the bottom. The Swiss franc sank deep into negative territory.
And you know, the franc didn't just have a bad Friday. It wasn't a sudden one-off shock. It was actually the only major currency to start the week in the red and then just maintain a steep, one-way downward trend the entire week. Its cumulative drop literally dwarfed every other currency out there. It was, without a doubt, the undisputed loser of the week. Not even close.
The really crucial point here is that this wasn't some slow, quiet bleed. The Swiss franc completely dominated the volatility charts. We're talking the steepest downward slope and the largest absolute value of fluctuation among all the major pairs. The sheer momentum and massive size of this drop made it the absolute most prominent trading narrative of the week. It was the story everyone was watching.
Which brings us to the why. How does a safe haven fall that hard? Well, we've lined up four primary suspects that basically conspired to drive the franc into the ground. First, a fundamental driver in central bank policy divergence. Second, the fundamental reality of weak domestic economic data. Third, mechanical capital flows driven by risk-on sentiment and month-end rebalancing. And finally, some short-term shocks from rumors and cross-pair linkages. Let's break these down one by one.
Moving right along to suspect number one, the central bank policy gap.
This right here is the bedrock of the entire move. We're talking about a massive widening gap between global central banks. The contrast is literally night and day. On one side, you have the U.S. Federal Reserve. Sure, the market expects them to hold rates steady in July, but they're keeping a very distinctly hawkish edge. In fact, markets have priced in a one-third probability of a rate hike, expecting a tough stance on inflation. That obviously shores up the dollar's advantage. Then, on the complete opposite side, you have a deeply dovish Swiss National Bank. They are stuck at a 0% base rate, and everyone expects a long-term hold or maybe even cuts down the road. It's a foundational gap. You've got a hawkish eagle on one side and a very sleepy dove on the other.
And honestly, it gets even worse for the franc, because it's not just about the numbers, it's about the attitude. Institutional consensus tells us something pretty fascinating. The Swiss National Bank is actually happy to see the franc weaken. Yeah, they're perfectly content with this slide and have absolutely zero desire to step in and forcefully intervene to stop the bleeding. So, the franc has this huge interest rate disadvantage, and its own central bank is practically holding the door open for it to leave.
All right, let's look at suspect number two, the domestic reality. So why is the central bank acting so dovish? Well, this single number is our smoking gun, 1.5%. That was the Swiss real retail sales growth year over year for June. To put that into perspective, the market was expecting 3.1%. That is a massive, glaring miss and a really significant drop from previous figures. When you pair that kind of sluggish consumer momentum with Switzerland's historically low inflation, it completely takes the pressure off the central bank to tighten monetary policy. I mean, this miserable economic data just completely validates their extreme dovishness. It essentially proves to the market that the S&B has zero reason to raise rates, which naturally just pushes more sellers into the market as reality sets in.
Now for suspects 3 and 4, market mechanics and shocks.
Beyond the fundamentals, we have to talk about the market's plumbing, the mechanical capital flows, and sudden external shocks that basically poured gasoline on the franc's fire. First, let's look at capital flow. It's really a three-step chain reaction. Step 1, global stock markets had a phenomenal July, creating a huge risk-on environment. And in that environment, investors don't want safe havens, they want growth. Step 2, we hit the end of July, which means institutional fund managers hit their window for portfolio rebalancing, which leads to Step 3. To match their benchmark weights against those rising equities, they're practically forced into an end-of-month technical adjustment where they dump low-yielding safe haven assets, like the Swiss franc, to buy US dollars. Add to that our final suspect, short-term shocks. On Friday, we saw these chaotic rumors swirling around about Japanese authorities and the U.S. Treasury potentially intervening in the yen. And what did that do? Well, it spiked the volatility of the U.S. dollar index. Even though it was mostly an intraday disruption, that resulting overarching dollar strength acted like a heavy weight, putting this persistent downward suppression right on the franc. It was literally the perfect storm capping off an already brutal week.
So, bringing it all together, the verdict and what's on the horizon.
After laying out all the evidence, from central bank policy to retail sales to portfolio rebalancing and Friday's rumors, the verdict is crystal clear. This is not some random, single-event, short-term fluctuation. No, this is a structural, sustained, trend-driven sell-off. Because it's so deeply rooted in the divergence between the hawkish Fed and the dovish S&B, and backed by very real, very weak economic fundamentals and institutional capital flows, this weakness is likely here to stay. As long as those two central banks stay on opposite paths, downward pressure on the franc is the dominant reality.
Which leaves us with the ultimate question, and the exact thing you should be watching for next week. We're getting crucial Swiss inflation data. So, will those numbers finally act as a catalyst, forcing the Swiss National Bank to change its dovish tune? Or is the world's ultimate safe haven currency doomed to just keep sliding down the charts? That is the key variable to watch, and the answer will dictate the next chapter of this incredible market story. Thanks so much for joining me for this explainer. Keep your eyes on the data and keep learning.